Okay, let's unpack this. The market action on September 24th, 2025. If you just glanced at the final closing numbers, well, you might think it was a pretty quiet session. Just the second day in a row with a modest dip. Most analysts are quickly calling it necessary consolidation.
And yeah, you'd be entirely missing the point there,
Yeah.
because beneath that, like seemingly orderly surface, the U.S. equity markets were just churning. I mean, intensely, almost violently in some spots. This wasn't some gentle retreat. It felt more like a dramatic, sharp divergence of capital. And it was fueled by these two really powerful kind of contradictory forces. You had sudden geopolitical fear popping up, and then these highly specific, almost binary corporate events on the other side. It really was a market of contrasts.
Right. That's the real story we're diving into today. We've got a stack of sources here, detailed post-market reports, analyst notes, macroeconomic updates, and we're trying to connect the daily movements, across indices, sectors, individual stocks to the two big levers right now, the Federal Reserve, obviously, and this escalating global conflict. It's a complex picture, almost paradoxical sometimes.
Definitely. So our mission for you, the listener, is really to provide a kind of blueprint for navigating this complexity. We're going to zero in on three major tensions that really define September 24th, and honestly will probably dictate where things go for the rest of the month. First, that tactical pause in the broad market rally, and crucially, the authoritative justification behind it. Second, this massive sector rotation happening, we're calling it the Great Divergence, is pretty stark. And third, that growing collision course between the Fed's very carefully managed dovish tilt and this sudden, frankly, unwelcome surge of geopolitical inflation coming from energy prices.
Okay, let's start with part one then. The broad market performance, that orderly retreat you mentioned. So setting the scene, context is key here, right? This two-day retreat, it signals consolidation. It feels like a healthy, maybe necessary reassessment of risk after that really powerful three-day rally we saw. That rally pushed indices up to record highs just, 2 days earlier, Monday, September 22nd.
Exactly. And the narrative here is really important. The market seems to be recalibrating, absorbing those big gains. It's not panic.
Right, not panic. Let's look at the numbers, the closing stats.
Okay, so the benchmark S&P 500, it closed the session at 6,637.97.
Yeah.
That was down 18.95 points, which, percentage-wise is pretty modest, a decline of just 0.28%.
Okay, and the Dow Jones Industrial Average, the blue chips?
That finished the day at 46,173.46. It was down a bit more, 177.59 points, so about 0.38%.
And the NASDAQ Composite, often a bit more volatile.
Right, and ended the day at 22,497.86. That was a loss of 75.62 points, translating to about 0.33% down.
But look, you have to remember, like you said, where we started the week. Even after 2 down days, the S&P 500 on Wednesday closed only, 0.83% off that record high from Monday? If this was real fear, those numbers would look drastically different. This kind of drop, it's almost noise compared to the rally structure.
Okay, let's dig into the market internals then, because this is where you see the quality of the move, right? There was pretty clear evidence institutions were, taking some chips off the table. Market breadth, for instance, was decidedly negative. On the NYSE, declining stocks outpaced advancers by about 1.12 to 1.
And even more pronounced on the NASDAQ, right? About 1.61 to 1 decliners to advancers there.
Yeah.
And this is kind of backed up by the volume data. Volume is up. We saw 18.89 billion shares traded on Tuesday. That's quite a bit higher than the 20-day average, which is around 17.66 billion.
So what does that elevated volume on a down day really tell us? It suggests active repositioning. It's not just passive selling or, retail investors getting scared. This looks like big institutional money actively locking in some of those gains and reallocating capital.
Yeah.
They were distributing shares, not just dumping them wholesale.
And crucially, the VIX, the volatility index, the market's fear gauge, as they call it, it only ticked up marginally, increased about 3.4% to 16.64.
Yeah, I mean, that signals maybe a tiny bit of anxiety, but that level, 16.64, is still historically really subdued, very low.
Absolutely. If we were seeing real panic, that VIX number would be heading towards, 30 or 40 easily.
Exactly. A VIX at 16.64 pretty much confirms this was an orderly decline. Investors were maybe cautious, sure, but definitely not running for the exits. Which brings us to, I think, the most fascinating question of the day. What gave these institutional investors the green light? What was the authoritative justification to actually lock in those profits right then?
And this is where it gets really interesting. It seems to point directly to Federal Reserve Chair Jerome Powell's explicit warning on Tuesday. He stated, pretty clearly apparently, that some asset prices, and he specified particularly risky equities, appeared highly overvalued.
Yeah, that phrasing is It's highly unusual. You could almost say borderline unprecedented coming from a sitting Fed chair in such specific terms. Central bankers usually try really hard not to comment directly on stock market valuations, right?
Yeah.
For fear of triggering the very thing they're warning about.
So when he actually says highly overvalued,
He's essentially handing institutional portfolio managers a gift, isn't he? It's like an official, non-technical excuse to sell into strength. They don't have to worry about professional critique. Why'd you sell at the top? Well, the Fed chair told me to.
huh, right. So if I'm managing a big fund sitting on huge gains from that rally, and maybe I'm getting a bit nervous about the peak, Powell just gave me perfect cover. I can just say, look, the Fed chair said it was overvalued, so I de-risked. Simple as that.
Precisely. So the market's reaction wasn't some disorganized rout. It was actually a highly rational response. You had this technical peak in the market colliding with a very cautious signal from arguably the most powerful financial voice in the world. It gave the all clear for that necessary profit taking. So this measured decline, it was rational, professional, and you can trace it pretty much directly back to Powell's words. It was really the only catalyst needed, it seems, to tick off that consolidation.
Okay, so moving past the broad indices now, let's look beneath the surface at the sectors, because this is where that market of contrasts idea really comes alive. The S&P 500's 11 sectors showed a market that was, well, deeply divided. Broad momentum just took a total backseat to these really distinct, opposing rotational themes.
Yeah, this divergence tells us that capital is being incredibly selective right now. Money was flowing quite decisively, actually, toward assets that benefit from geopolitical instability specifically, things that thrive when oil prices go up. And at the same time, it was retreating from areas sensitive to, say, valuation concerns, or, as we saw, these really acute operational risks.
Right, and the big outperformer, undeniably, was energy. The S&P 500 energy sector posted a really strong gain, up 1.3%. And that was continuing its strength from the day before, too.
Absolutely. And this outperformance, it just stood in stark contrast to the negative broader market. It was fueled entirely by that sudden surge in crude oil prices, reflecting that immediate geopolitical risk premium we talked about.
Okay, let's talk about those crude drivers. WTI, the U.S. benchmark.
WTI advanced 2.2%, settled around $64.80 a barrel. And Brent crude, the international benchmark, climbed 2.5% to close at $69.31. And we're not just talking about, the usual OPEC production quotas here. This feels much more about immediate supply threats.
Can you break down those specific threats again? What were the key geopolitical things driving oil specifically on the 24th?
Yeah, there are basically three things creating this kind of confluence of anxiety. First, you had these escalating NATO-Russia tensions, sparked by those recent Russian airspace incursions. Now, that doesn't just raise political eyebrows. It seriously raises the fear of disruptions to Russia's huge crude oil exports, through pipelines, ports, especially if Western sanctions tighten up or, military actions escalate. That's potentially explosive for supply.
And the ongoing attacks in Ukraine are still a factor.
Absolutely. That's the second piece. Ukraine's continuing its campaign, and it seems quite effective, of drone strikes targeting critical Russian energy infrastructure. We're talking refineries, export terminals, especially near the Black Sea. These attacks cause real, tangible, real-time supply drops. When a major export terminal gets hit, that supply doesn't just wait around. It's delayed, maybe curtailed entirely. That immediately tightens the physical market.
Okay, and the third factor was more Middle East related, a slower burn maybe.
Yeah, that's the persistent, ongoing suspension of about 230,000 barrels per day of crude exports from the Kurdistan region of Iraq. Now, while that's smaller than the potential Russian risk, it's been this sort of constant drag on global supply. It prevents the market from building up any comfortable buffers. So you combine those three elements, the explosive political risk with Russia, the tangible operational damage in Russia from strikes, and this chronic undersupply from Iraq, and bang, you get a significant immediate risk premium baked into crude prices.
And that strength showed up clearly in the stocks. Phillips 66, PSX, was up more than 3%, and natural gas producer EQT climbed over 4%.
Yeah, it just highlights how profoundly sensitive this whole sector is to global supply anxiety and, frankly, to global conflict.
Okay, now let's flip to the other side, the materials sector. Finished with the steepest loss of the day, down 1.6%.
Right, and where energy rose because of systemic risk, broad geopolitical stuff, materials fell primarily due to an idiosyncratic failure. It was a highly specific single-company operational disaster that just cast a shadow over the whole group.
And that specific event was the collapse of mining giant Freeport-McMoRan, FCX. It tumbled what, a staggering 17%.
Yeah, huge drop. And the reason was they were forced to slash their sales forecasts for both copper and gold.
And the details behind that are pretty stark.
They really are. The company's Grasberg mine in Indonesia, which is a critically important facility for them, suffered severe operational disruptions. It was due to a mud flow, which tragically also resulted in the deaths of 2 workers. This forced FCX to declare force majeure. Now, for listeners, that legal term is incredibly significant. It basically means they're legally released from their contractual obligations to deliver copper and gold because the disruption was unforeseen and totally beyond their control.
So the market isn't just reacting to a missed revenue number here. It's reacting to the sheer shock legal, operational that just rippled through the entire supply chain. But why did one mining giant drag the whole sector down so much?
Well, because XCX is such a massive player, especially in essential materials like copper. When a company that big declares force majeure on commodity contracts, it signals a potential systemic shock to global supply chains. It increases short-term price volatilities for those commodities and, frankly, raises questions about the stability of the entire materials sector's operational execution. Can others manage their mines safely? It just underscores the extreme vulnerability of these resource-reliant sectors to these non-financial, physical, totally unpredictable operational events. It was a really unforgiving reaction to both tragedy and failure.
Okay, let's move on to technology. Its overall decline, somewhere between 0.5% and 0.7%, actually hid what you called the session's real aha moment. The headline weakness looked like straightforward profit-taking in the big mega caps, Oracle down 1.7%, Nvidia down almost 1%, Amazon down a bit, Micron Tech down nearly 3%.
Exactly, that was the surface story. But the underlying reality was this massive, quite decisive bifurcation within tech. This is that great divergence theme playing out again, but inside a single sector. While the Magnificent Seven type stocks generally faltered under valuation pressure, a very specific group of companies, those tied directly to the actual capital-intensive build-out of AI infrastructure, posted exceptional gains, totally bucking the trend. It feels like the difference between investors buying the sort of vague promise of AI versus buying the actual shovels needed to dig for AI gold.
And we definitely saw those shovel companies surge.
Yeah.
Intel, INTC, was up 6.4%. That seemed driven partly by reports of a potential strategic investment from Apple, but maybe more importantly, a positive outlook for its core server market, which is obviously essential for training these huge AI models.
Absolutely. And then look at Marvell Technology, MRVL. They're a key provider of data infrastructure, hardware, networking, storage stuff. They were up more than 7%, actually leading all the gainers on the NASDAQ composite that day. They were literally selling the picks and shovels.
Yeah.
And what about Alibaba? Their U.S.-listed shares jumped 8%. That's fascinating because it's about them committing capital, not just, say, reporting higher cloud revenue.
Yeah, Baba's move is really critical because it highlights the global nature of this AI infrastructure investment push. They announced they were dramatically increasing their budget for AI infrastructure and models. This isn't just about them selling more cloud server space. This is about them pouring serious cash into physical hardware, into data centers, into advanced chips. It signals huge confidence from a major global player that the AI spending cycle is not only real, but accelerating. And importantly, the capital right now is flowing to the companies that facilitate that physical build-out, almost regardless of what the broader tech sector or the mega caps are doing.
So what does this big internal rotation within tech really mean for the average investor trying to make sense of it all?
Well, I think it signals a definite maturing of this phase of the bull market. It feels like we're moving beyond that sort of generic enthusiasm phase of just buy the big tech monoliths and hold on. Investors are now engaging in highly selective capital allocation. They're really differentiating between companies that might merely benefit from AI, often the ones with already stretched valuations, and the companies that provide the necessary physical plumbing for AI, the ones with clear near-term contracts, visible order books, tangible catalysts. It's kind of a shift from betting on an abstract growth promise to investing in concrete industrial execution.
Right, so that broad market consolidation, it kind of created a vacuum, didn't it? And individual corporate stories, both triumphs and failures, just rushed in to fill that space. With no strong overall market direction, the difference between, say, a 200% gain and a 17% loss came down to a single press release in some cases. It really underscores why that bottom-up fundamental analysis is just absolutely paramount right now. It's a stock picker's market, as they say.
Yeah, the session was a perfect, almost textbook illustration of binary risk in action. And the most dramatic winner by far was the gene therapy company Uniqure NV, ticker QURE. I mean, their stock reaction was almost unbelievable. Shares skyrocketed over 240%, closed near $48, and the trading volume was insane. Something like 65 million shares traded compared to their average of maybe 1 million. This is the kind of move that literally transforms portfolios overnight.
And the catalyst was just monumental, wasn't it? Positive top-line data from a pivotal phase 3 study for AMT-130. That's their one-time gene therapy candidate for Huntington's disease. And the key detail was the efficacy number.
Right, the drug showed a statistically significant 75% slowing of disease progression at the 36-month mark. You really have to translate that data point into human terms to grasp the significance. Huntington's is this devastating, relentlessly progressive neurodegenerative disorder. There's no cure. So a 75% slowing of progression over 3 years, that's not just a modest improvement. That's potentially a complete paradigm shift in how you treat this disease. The market wasn't just pricing in trial success. It was pricing in a potential multi-billion-dollar commercial opportunity for a truly life-altering therapy.
And that success had immediate knock-on effects, right, throughout the sort of ecosystem.
Absolutely. Unisure's delivery partner, a company called ClearPoint Neuro, CLPT, they make this specialized device used to deliver the therapy directly into the brain. Their stock surged 59%. The market instantly understood. ClearPoint's technology just became critical infrastructure for what could be a revolutionary drug.
And Uniqure themselves made a pretty savvy strategic move right after that huge stock pop.
Oh, yeah, masterful timing. They immediately announced a proposed $200 million public offering right after the market closed. That's corporate finance 101, right? Seize the moment, capitalize on that euphoria, lock in the funds you need for the really expensive phase 3 trials and eventual commercialization. They turns clinical success instantly into a much stronger financial position. Very smart.
Okay, let's shift gears slightly. Talk about the power of just removing uncertainty. Xcel Energy, XCL, rose a pretty robust 6.7%. The catalyst there was settling litigation related to that devastating 2021 Marshall Fire in Colorado. They settled for $640 million. Now, that's a big number, $640 million. Why did the stock react so positively to paying out that much money?
Because it's all about eliminating tail risk. Before that settlement, Excel was facing potentially catastrophic, completely uncapped liability. Could have stretched into billions of dollars, dragged on through years of legal battles. That major legal overhang, as analysts called it, was absolutely priced into the stock. It acted like this persistent discount. So by settling for a known defined number, $640 million, the company replaced basically infinite uncertainty with a finite manageable cost. In the utility sector, which investors love for its predictability, that kind of clarity equals immediate value unlocked. They crave certainty.
Makes sense. And we also saw operational efficiency get rewarded with Centene CNC gaining 5.8%. Their positive move seemed tied to an announcement that one of their subsidiaries paid out $15 million in value-based care incentives to medical providers. Explain that a bit.
Yeah, this is a classic insurance sector story. Managed care organizations like Centene, their whole business model kind of lives and dies based on their ability to manage medical costs effectively. So by using these financial incentives to reward doctors and hospitals for delivering better, more efficient care, that's what value-based care means, Centene signaled to the market, hey, we're actively managing and successfully reining in these crucial medical costs. That's absolutely fundamental to maintaining their profitability margins. So the market views that as a significant operational win. They're executing well.
Okay, now for the flip side, the losers. And Harmony Biosciences, HRMY, perfectly illustrates the painful downside of that binary risk we talked about. They collapsed 16.51%.
Yeah, their failure was purely clinical and it was brutal. Their phase 3 Reconnect study, testing a drug candidate called ZYN002 in Fragile X syndrome, completely failed to meet its primary endpoint. So, where Uniqure had this incredible breakthrough, Harmony had a complete stall. It just shows you, the market for these unproven drugs really is a high-stakes lottery sometimes.
The company apparently pointed to a higher-than-expected placebo response rate, which I know is a notoriously tricky and persistent challenge in these neurobehavioral trials.
It is, but the market doesn't really care about the excuses once the trial fails. And the analyst reaction was instantaneous and absolutely decisive. Oppenheimer, for example, immediately slashed its price target and just completely removed the entire Fragile X indication from its financial models. Poof. Just like that, they erased that potential future revenue stream from the company's valuation overnight. That's how quickly these binary risks get priced or unpriced by the market.
Ouch. Lastly, Axon Enterprise, AXON, dropped a full 10%. Their decline seemed driven more by skepticism about their strategy, right? Even though the acquisition might have some long-term merit.
Exactly. The market reacted pretty negatively to their acquisition of a company called Prepared, which is an AI-powered emergency communications platform. Now, strategically, you can see the logic on a whiteboard, right? Integrating AI into emergency response workflows makes sense, but investors immediately focused on the execution risk. Acquisitions, especially ones outside a company's absolute core competency, always trigger concerns. Integration headaches, technology complexities, potential culture clashes. In a cautious market environment like the one we saw on the 24th, that fear of integration risk simply outweighed the potential strategic rationale for a significant number of shareholders. They voted with their feet.
Okay, so if those stock-specific moves were driving the day-to-day headlines and the big swings, the underlying reason for the broader market consolidation seems rooted in this much more fundamental conflict. It's the Federal Reserve's desire to kind of maintain this gentle easing path versus this sudden, sharp surge in energy prices being driven by external global instability.
Yeah, this geopolitical oil shock is really the overarching macro headwind right now. It threatens to derail, well, potentially everything the Fed is trying to do. We talked about those three drivers earlier: the Russia-NATO tensions, the Ukrainian strikes on Russian infrastructure, the Iraqi supply suspensions. Collectively, they've just injected this massive and frankly unwelcome risk premium straight into the price of crude oil. The market is effectively pricing in the risk that supply could be weaponized, or at least severely disrupted, very quickly.
Let's dig a bit deeper into the magnitude of this threat. Why is a sustained rise in oil prices such a huge deal right now, especially considering the Fed just delivered its first rate cut of 2025? Isn't the inflation fight basically won?
Well, that's the trillion-dollar question, isn't it? Oil is just such a foundational cost for the entire global economy. A sustained rise feeds directly into transportation costs, trucking, shipping, airlines. It hits manufacturing input costs, and eventually it hits consumer prices, especially at the gas pump. It has the potential to reignite headline inflation, particularly the Consumer Price Index, CPI, which the Fed watches closely. And if inflation flares back up specifically because of energy prices, it completely undermines the Fed's whole data-dependent policy stance. Remember, they just brought that target range for the federal funds rate down to 4.0–4.25%. That was a big move.
So if oil pushes core inflation, or even just headline inflation, significantly higher, what happens to that whole rate cut trajectory the market was banking on?
It's immediately jeopardized. The market suddenly faces the very real risk of a forced hawkish policy reversal. Instead of continuing with the measured cuts that futures markets are pricing in, the Fed could be forced to pause those cuts indefinitely. Or, in a real nightmare scenario for the markets, they might even have to reverse course and start hiking rates again.
Wow.
That prospect introduces substantial volatility and risk back into every single rate-sensitive sector. Think housing, utilities, consumer discretionary stocks. And it would likely halt this broader equity rally dead in its tracks. So yeah, the oil price right now feels like an almost existential threat to that whole dovish narrative.
Meanwhile, back on the 24th, the market consolidation was also heavily influenced by how people were interpreting the Fed's commentary, especially Powell's. He delivered that really direct, unambiguous warning on Tuesday, explicitly calling out risky equities as being highly overvalued.
Right. Powell seems to be signaling that while, yes, they want to achieve that elusive soft landing, maybe the market is running a bit too hot. Perhaps the market overinterpreted their recent rate cut as some kind of open invitation to just go full risk on euphoria. His stance feels very much one of caution and prudence. He warned against cutting rates too aggressively and potentially leaving the inflation job unfinished. That measured approach definitely disappointed some market participants who were maybe hoping for a faster, more aggressive pivot back towards lower rates, arguing that inflation is already basically tamed.
And this brings us to what you called the policy fog earlier. These growing and very public divisions within the Federal Open Market Committee, the FOMC itself. This division seems to be creating maximum uncertainty about the future path for interest rates.
Absolutely. The FOMC right now seems split into two pretty visible factions, maybe more behind the scenes, but two visible ones. On one side, you have Powell's more cautious cohort. These are the consensus builders, the ones prioritizing that data-dependent approach. They're focused on things like wage growth, the state of the labor market, services inflation, before committing to more cuts. They seem to accept the current rates as broadly restrictive, but maybe still necessary for now.
Okay, and on the other side, we saw that more vocal contingent publicly pushing for faster action, citing Trump-appointed officials like Governor Stephen Miron.
Yeah, Miron and the more aggressive cutters, they're basically arguing that the inflation job is essentially done, that it's conquered. They believe the current policy rate of 4.25% is actively damaging long-term economic growth and unnecessarily restricting the labor market. They seem to think the Fed is risking a recession by being too slow, too cautious. And they've publicly stated the policy rate should drop significantly lower, maybe even down towards 2.0%.
Wow, dropping the rate all the way to 2.0%. That would represent a fundamental shift in economic policy and certainly in market pricing. What would that imply for growth sectors?
Oh, it would be pure rocket fuel for growth stocks, technology, anything sensitive to the cost of capital. It would essentially remove the cost of money as a major constraint. But the market now has to constantly contend with this fundamental question. Which faction is actually gaining influence inside the FOMC? Is it the aggressive cutters or is it Powell's cautious camp? Because the difference between a 4.0% Fed funds rate and a 2.0% rate translates into literally trillions of dollars in overall market valuation.
Yeah.
This internal disagreement just complicates every single investment decision right now. It adds this layer of political and, frankly, philosophical risk that investors haven't really had to deal with so acutely in years. It's exactly why every syllable uttered by any FOMC member is now being scrutinized under a microscope, looking for clues about which side is winning the internal debate.
Okay, so to try and synthesize this really complex day, a day where these macro and micro forces were just pulling in completely opposite, often dramatic directions, we saw, three defining tensions emerge. These seem to be at the forefront of investor focus now.
Yeah, I think that's right. First, you have consolidation versus catalysts. The overall market is definitely pausing. It's absorbing those big technical gains from the rally. But underneath that quiet surface, dramatic values being created, think Uniqure, Excel, or absolutely destroyed, think SEX, Harmony, entirely on a stock-specific, catalyst-driven level. It really feels like the era of just passively buying the broad index might be giving way, at least for now, to a much more intense stock pickers market. Execution matters hugely.
Okay. Second key tension, technology bifurcation. That focus is shifting rapidly and decisively, it seems, away from just generic mega-cap growth towards highly selective investment in the capital-intensive AI infrastructure build-out. Capital seems to be chasing the concrete execution, the actual hardware, the chips, the data centers, much more than the abstract promise of AI benefits down the road.
Precisely. And third, the big one, the macro conflict that just looms over everything else. That deeply entrenched desire across the market for a dovish Fed pivot is now being directly challenged head-on by the sudden reemergence of this potent geopolitical inflation threat, specifically coming via crude oil prices. And that conflict is what dictates whether the current 4.0% Fed funds rate is maybe the bottom, or perhaps just a temporary pause before a much more significant shift, maybe even upwards.
Right. So the trajectory of the market heading into October seems to rest almost entirely on how these three big tensions resolve themselves. So what specific things should we and our listeners be watching most closely in the coming days and weeks?
Okay, number one, immediate and intense scrutiny has to be placed on geopolitical developments. Specifically, the trajectory of tensions involving Russia, Ukraine, and NATO. That's what's going to dictate near-term oil prices. If WTI or Brent crude breaks decisively above, say, $70 a barrel and stays there, the Fed's hands might become tied, almost regardless what the other inflation data says. Energy could trump everything.
Okay. And obviously, Fed watching continues. We need to keep scrutinizing every public speech from Fed officials.
Absolutely. You have to look for any subtle shifts in language, any nuance that might suggest which faction Powell's cautious cohort or the aggressive cutters like Mirren seems to be gaining influence within the FOMC. That tells you the likely future direction of policy.
Makes sense.
And finally, I'd call it the AI litmus test. We need to watch for continued decisive strength in that specific AI infrastructure cohort. Those companies like Intel, Marvell, maybe even NVIDIA in certain segments, and global players like Alibaba committing capital to the physical build-out. Their continued strength is really a crucial barometer for the health and the sustainability of the core bull narrative right now. If the money stops flowing into the actual tools that build the future of AI, that would signal some deep structural doubt creeping into the market.
Okay, so that leaves us with maybe a final provocative thought for you, our listener, to mull over. If these high-profile corporate failures we saw, like Freeport-McMoran's mine disruption or Harmony Biosciences' clinical trial failure, caused such sharp, immediate, and frankly unforgiving reactions, not just in their stocks, but across their entire sectors, are we actually seeing a market emerge that is fundamentally less tolerant, less forgiving of operational mistakes and these binary risks than it was maybe just during the more, shall we say, euphoric buying of the previous months? And if so, what does that potentially mean for the risk premiums we should assign to individual individual stocks as we head into the next earnings season. Something to think about.